Hello, everyone. I'm so excited to be interviewing Dalia Barsoum, CEO of Streetwise Mortgages. In today's video, we're going to talk about the 7 dumbest ways to die in your real estate investing journey. Dalia and her team are ranked in the top 100 global mortgage professionals in Canada, and her team are super passionate about helping investors build massive wealth through real estate investing. If you are an aspiring real estate investor or you're in the thick of your real estate investing journey, looking to buy multiple rental properties, then you definitely want to check out today's video. I want to mention, I know you've worked with a ton of people, you and your team work with a ton of real estate investors, and you come across many different situations, strategies, and markets, and you come up with this list. This list is called the 7 dumb ways to die. Wow, that's pretty dramatic in real estate financing. So I was just curious, how did you even come up with the name in the list?
Here's the thing. I actually want it to be real because, on social media and news and all of that, you see the fun and successful side of real estate investing. I, as a mortgage broker, get to see things behind the scene that sometimes are fatal, and there are mistakes that people make along the journey. And I thought, you know what, let me share those, because sometimes investors do things without realizing what they're getting themselves into. And I looked back at the different things we've seen, and I've condensed that list to the top 7 mistakes that I've seen, and I call them dumb ways to die, because literally you can kill your deal or lose money or ruin your reputation in this small investment community, making these mistakes.
Okay, well, I need to hear them. Okay, so let's talk about the number one. What's the most common way that you've seen so far?
There are several things, but the one that I see often, Tracy, is high leverage. So investors basically want to pick properties with creative financing, and there is so much private money to be lent to investors these days. There is an abundance of it. So it's easy to utilize private money to pick a property or to fund a renovation and so on. And what I've seen in some investors do, unfortunately, is take too much private money and maybe take a high loan to value position on a property, meaning 90% or 100% even. My point is, I've seen investors use private money to the maximum, and when things go wrong, they're they cannot exit the deal, meaning they have to sell. They will be forced to sell, or if they haven't thought about how they're going to pay that money back by validating that they can refinance it, they may get stuck with that private mortgage, and it becomes very expensive, or they have to find quick solutions on the fly to exit that money. So that puts investors under tremendous amount of stress.
Okay, so let me clarify this. So when you talked about private money, you're talking about, like, say me, I'm gonna go and I'm gonna go buy a property that is like during the middle of COVID, and it's probably like at the peak of the housing market. We're talking about like a $900,000 property, and I get money from someone else, not the bank. And is that not the bank? Okay, so then you're talking about a situation where it's like peak of the housing market, things can change, and the house is appraised for million, but maybe it's only worth like 750 like 2 years ago. And then now we come 2 years later, like 2 years after COVID, and the situation's changed. What if the housing market is getting to become like a normal housing market? So then what you're saying is that that investor is stuck, right? Like they have no potentially, if the market's changed from now the house is not worth a million, maybe it's 950, but they're leveraged to 95% loan to value, which is meaning they took a lot of debt. Are you saying that they may not have a way out with the banks because the appraisals, right? Appraisals, banks appraise properties, right?
That's one example of the market turning. And if the investor bought the property with a big private loan at the beginning and the value has gone down, then they cannot refinance it at 80% and get enough money to pay back that private loan. That's one example. Another example is, an investor goes and gets $500,000 private loan on a property, and let's say the property is worth 600 and something, so very high leverage position. Their project doesn't finish in the intended amount of time, in 3 months, taking 6 months, and they got a loan that expires in a short time period. they need to extend it, but maybe the private lender doesn't want to extend. Now the clock is ticking, so they either have to go find alternative source of money or a quick way to pay back that lender. So that's another example of using leverage without planning for the worst case or without planning a buffer or thinking about exit strategy.
So, I mean, this is why, like, when you see those infomercials and the books and the advertisements that always say no money down real estate investing, that's the type of scenarios we're talking about that can get you into a lot of danger.
We've done many deals with creative financing, meaning you can go buy, for example, a property with a private first mortgage and take a vendor take back second, possible, or a vendor take back from the seller, possible. That these are all creative methods. However, again, you got to use it. You got to understand what you're getting yourself into and plan for an exit. So if someone says, you know what, I'll take this private money now and I should be able to refinance once my project is done, well, let's validate that and let's make sure we plan for the worst case scenario, because that's where, you know, the rubber hits the road. You got to make sure you're going to be able to exit and you plan for the worst case.
What's another way, common way that you've seen that could really end your real estate investing journey?
Okay, so I've seen some investors ask this question: can I buy a rental property with 5% down? The 5% down program is intended for clients that who will occupy the property or live in it at least for some time. It's not a quote unquote creative strategy to buy rental properties with. Um, that would be considered mortgage fraud. And even if an investor succeeds in buying a property with 5% down, here's what happens: a rental property with 5% down. Here's what happens with the banks and the lenders. You know, there are big groups of lenders, but behind the scene, they all deal with three mortgage insurers: CMHC, Genworth, and Canada Guarantee. So at the end of the day, any 5% down deal goes back to these three insurers. So here's what happens. If a deal closes and the property ends up being a rental, not owner occupied, the mortgage insurers do random audits on properties, and they will go check Google, they will check the rental boards, and if they find that someone has closed the deal claiming it's a residence and it turns out to be a rental, they have the right to pull the mortgage. And we have seen that happen with people who have approached us with that situation. The
Wow.
though is, you know, that client gets marked on the insurer books, and because there are only three of them, everybody will pretty much get to know about it. So not a creative strategy. I highly discourage thinking about it that way. If you're going to occupy the property, yes, and you qualify with a 5% down, absolutely. But it's not a way to buy a rental with less money down.
You need to occupy the property, right? And need to live in the property. And then if you decide to convert it to rental, you should disclose that to your bank. And that way you don't get into this black mark situation. But you're talking about a situation where someone has gone out just with a 5% down, had no intention of living in that property. So then I know that there's many weeks, like, you know, I'm just thinking about how many properties I've financed through you and the time it takes to get pre-approval, and then it takes weeks to months to get approval because you need to find a property. Situations can change. So I'm wondering, what are common things that you've seen that really derailed the pre-approval to approval stage?
Okay, so let me clarify. A pre-approval is you sitting down with the mortgage advisor or the broker or the bank. You know, they will crunch the numbers and say, here's what you qualify for. The key thing that you should be going after as an investor buying a property is something called pre-qualification, not pre-approval. Okay, and it doesn't change the wording on the piece of paper that you're going to get. It basically implies that the person you're working with has double checked all of the documents that you're providing, tooth comb them, so that when you go and buy a property, they're not checking that in detail for the first time. Give you an example. Someone who's self-employed, they tell their broker that they make $100,000. Okay, if the broker takes the 100,000 and runs it into a calculator, they can go back to the client and say, hey, you qualify for a $600,000 purchase. Well, that's a similar to a pre-approval, but If they take a look at the documents, the tax returns, the company information, that client may be making 100,000, but it's in their company. When the time comes for the lenders to take a look at the documents, they're not going to take that 100,000 into consideration. They're going to take whatever that client pays themselves personally if they're dealing with a bank. So here's an example of using a number to say, here's how much you qualify for, but looking at the documents qualifies you for a completely different number. So what you want to make sure of is that the advisor you're dealing with has checked your income documents, has checked your down payment in details, has checked who's going to be working with you, if they're going to go with you on the deal, has checked your credit. You don't want anybody to take a look at that for the first time when you have an offer. Because a pre-approval is conditional on down payment, income, appraisal, blah, 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 blah. So we want to iron as many of these early on in the process versus later when you find a deal. Because if you leave it till that point, that's when surprises pop and numbers change and it's too late.
Okay, so this is something that an investor should ask for as a pre-qualification, right? Which means they literally the broker and your team would go through all the paperwork to see that it checks out before you know how much you can afford to buy as your next rental, right?
As if it's a live deal.
So I was curious, like, what are some things that are commonly not disclosed? Like, is there mistakes that investors make? I imagine this is one of the big things that people could end in their journey.
Let's say you have a property that you own, but the mortgage is not showing on the credit report. Some investors may think, you know what, it's not showing on my credit. Why should I talk about it? I may as well just keep it out of the picture. It's not, it's not showing on my credit report. Well, no, you got to disclose everything, whether it's in a company name, whether it's showing on the credit report or not showing on the credit report. Disclose it, because if you don't, and let's say you get a pre-approval or a pre-qualification done without factoring that into the numbers, and later on you go purchase a property and the lender does a title search, okay,
Oh, title search, yes.
they will find out about other properties that you own, and they're gonna now account for them into the calculation, but also they're gonna ask questions at that point in time, and you don't want that to happen during a deal. Therefore, my recommendation is always disclose everything and let your broker package the deal and present the deal at its best to the lender on your behalf.
Right. Okay. So you're talking about like a situation where it's private money lending and someone has a few properties, right? And it would show up in title if you're both on title. Okay. So then you think because it's not on your credit check that your broker doesn't need to do or your team doesn't need to know. But in reality, it actually hurts your reputation. I mean, once they find out and they start digging, they ask questions. That I imagine that's just like it's a very small community. Doesn't that ruin your reputation just by not disclosing this?
100%.
Okay.
100%. And Tracy, it doesn't have to be private money for it not to show on the credit report. There are lenders like B lenders, for example. Those are the lenders that are called also alternative lenders. It's not private money. Uh, Many of them don't report on the credit bureau.
Oh my gosh, I didn't even know all this could happen.
Right,
Okay, Dalia, thank you so much for your time and sharing your expertise. I heard you have some announcements, and this is related to all the things we just talked about. Can you share what it is and let the investors know where to find you and your team?
Yeah, absolutely. So we are rolling out a great service to investors called the financing roadmap. So essentially, we do complimentary planning sessions for investors who come to us and tell us what their goals are in real estate. And in this session, we go over where they are, what they're looking to achieve. We talk about how we're going to maximize their borrowing power. We talk about the mistakes that they need to avoid and be proactive about those. We talk about what financing would look like for their first, second, third property and how they're going to structure it. And we talk about many other things. And after the planning session, we give you as an investor the financing roadmap that outlines everything on how you're going to move forward with your financing your portfolio. So that's the service that we're rolling out formally this month, and investors can book their planning session at info@streetwisemortgages.com. They can speak with one of my amazing senior advisors, and we'll help them design their financing roadmap.
Man, that's amazing because I know I've been through this with you, and it was just like a huge relief, like just lifted like it was like a burden before, and then your team just like lifted it from my shoulders because it gives people a confidence like this is you can go through this journey buying multiple rental properties as long as you're and it's great that you have this roadmap to help investors. So thank you so much, Dalia. This is such a great unique experience that you give and share, and it's so generous of your team to do this. So I'm gonna see you next month, Dalia. We're gonna talk about more about this. Anyways, I'll see you later.
I'll see you in the next video.